Your car insurance company wants to watch you drive. They've been pitching this idea for years under names like Snapshot, Drivewise, and DriveEasy. The pitch is simple. Let us monitor your speed, your braking, your phone habits behind the wheel, and if you're a careful driver, we'll reward you with a discount. Sounds like a win for responsible people. But here's the part that doesn't make the brochure. In January of 2025, the Texas Attorney General sued Allstate and its data subsidiary Arity for secretly collecting driving data on 45 million Americans through apps like Life360, GasBuddy, and Fuel Rewards. Not 45 million people who enrolled in a telematics program. 45 million people who just had apps on their phones. The data was collected through secretly embedded software and used to inform insurance pricing and sold to third parties. And just to make things even more interesting, a separate lawsuit revealed that a Florida driver opted out of Progressive's Snapshot program after buying a new Toyota, only to discover that Progressive already had his driving data anyways because it was flowing through the car's built-in connectivity features.
Welcome to your Money on Easy mode with Damien.
So the question of should you let your insurance company watch your driving is actually more complicated than it looks, because in a lot of cases, the watching may already be happening. Today, we're going to cover exactly what these programs are, what the real savings numbers look like, when your rates can go up from participating, and how to use the permission to profit test to make a clear decision for your own situation. Let's get into it. Now, before we do, remember, this is not personal finance advice. I'm just breaking down how these programs work so you can make a smarter decision for yourself. Your insurance company is probably already tracking how you drive. Here's what that means. On today's episode, we're doing a deep dive on auto insurance telematics programs, what they track, who's offering them, and what you're really agreeing to when you sign up. Telematics is just a technical word for usage-based insurance. The idea is pretty straightforward. Instead of pricing your car insurance based on demographic proxies like your age, your zip code, or your credit score, the insurance company monitors your actual driving behavior and builds your rate around that. In theory, it's a better deal for people who drive carefully because you're paying for your risk level rather than the statistical average of everyone in your demographic bucket. There are three main ways insurers collect this data, and it's worth knowing all three because they have different implications. The first is a plug-in device called a telematics dongle that connects your OBD2 port onto your dashboard. That's the same port that mechanics use to pull engine codes. This device reports back to the insurer while you drive. The second method is a smartphone app. You download it, it runs in the background, and it uses your phone's GPS, accelerometer, and gyroscope to analyze how you're moving, braking, accelerating, and whether your phone is in use. The third and most recent is built-in vehicle connectivity. Newer cars have data connections baked in, and some manufacturers share driving data with insurers through commercial agreements, sometimes without clear disclosure to you, the driver. So what do these programs measure? The standard signals are speeding, particularly how often and how far over the limit you go, hard braking events, which are sudden stops flagged as potentially risky, hard acceleration, time of day you drive, since nighttime is statistically a higher risk, phone usage behind the wheel, and total mileage driven. Some programs weigh these differently. Some flag nighttime driving heavily, others are lenient on mileage, others treat it as the primary signal. The major programs you've probably heard of are Progressive Snapshot, which is one of the largest and can be done via app or plug-in device, Allstate's Drivewise, done through the Allstate app, Geico's DriveEasy, which is app-based, and State Farm's Drive Safe and Save, which uses a combination of an app and connected car data. The pitch from insurers is that safe drivers are essentially subsidizing unsafe ones in the current system, and telematics corrects that by matching price to actual risk. Now, this argument has real merit. A 25-year-old who drives 15 miles a day, never speeds, and doesn't touch their phone while driving genuinely shouldn't pay the same rate as someone with an identical profile who drives 80 miles a day and brakes hard at every intersection. However, the complication is in what happens to the data once it's collected, and we'll dig into that in a few minutes. So go look up whether your current insurance company offers a telematics or usage-based insurance program. Just Google your insurer's name plus telematics or driving app. Don't sign up yet, just know what they're offering and what device or app they use. The telematics discount is real, but the average savings might be smaller than you think, and for some drivers, it goes in the wrong direction. We're talking about auto insurance tracking programs, and I want to walk through what the numbers actually look like because the marketing loves phrases like save up to 40%, and the math behind up to is doing a lot of heavy lifting. Here is what the research actually shows. A study found that the median annual savings amongst telematics users was $120, not per month, per year. That works out to about $10 per month. Among younger drivers on policies, the median was $245. Now, for drivers under 45 specifically, it was $145 per year. So $120 a year is real money. I'm not going to wave that off, but it's important to understand that the median, meaning half of all enrollees, saved less than that. And a state-level analysis in Maryland found that most enrolled drivers saw no premium savings at all from telematics participation. So we're not talking about a guaranteed 15 or 20% discount. We're talking about a program where the median outcome is around $10 a month and a meaningful number of people see nothing. Now here is the part that often gets buried. Several of the biggest car insurance telematics programs can raise your premium, not just lower it. Allstate, Geico, Liberty Mutual, Progressive, and Travelers all have provisions to increase rates if the data shows riskier driving patterns than expected. So you sign up expecting to prove you're a good driver, and if the algorithm decides you're not, you can end up paying more than you would have without participating. A Consumer Reports investigation found something particularly worth understanding. Some of these programs penalize behaviors that aren't within your control. Hard braking, for example, is flagged as a risk signal. But if you hit the brakes hard to avoid rear-ending someone who stopped short in front of you, you did the right thing. The telematics system, however, sees that as a red mark. Similarly, driving late at night is treated as risky because the statistical accident rate goes up after midnight. But if you work night shift and that's your commute, you're being penalized for your schedule, not your bad judgment. So telematics scores only the things that it can pick up. It doesn't know if you're alert, experienced, and paying attention. It just knows that you are on the road at 2 a.m. Now, the other thing to factor in is the enrollment discount. Many programs offer an immediate discount of 5 to 15% just for signing up before they've even looked at your data. That discount is real, but it's also a hook. Some programs then evaluate your actual behavior over a period of months and reset your rate based on what they find. If your monitoring period comes back with a few hard braking events or some late night driving, that upfront discount can shrink or disappear. So the math question is, what's your realistic savings scenario after the monitoring period, factoring in that rates can go up? For genuinely careful drivers with consistent schedules who don't drive at odd hours, the math can work out. But for a lot of people, it's less clear. So before you enroll in any telematics program, contact your insurance company and ask 2 direct questions. Can my rate increase based on telematics data? And what specific behaviors are penalized? Get those answers before you agree to anything. You might already be sharing your driving data with insurance companies and you never agreed to it. We're deep in an episode about telematics and driving data. We've been talking about what's happening with the data these programs collect because it goes significantly beyond what most people expect. Here's an example. In January 2025, Texas Attorney General Ken Paxton filed a lawsuit against Allstate and its subsidiary Arity. The allegation that Allstate and Arity secretly collected driving behavioral data on at least 45 million Americans by paying app developers to embed Arity's data collection software inside popular mobile applications. Those apps included common ones like Life360, a family location sharing app, GasBuddy, which I use to find cheap gas, and Fuel Rewards, which is a loyalty program. None of these are insurance apps, People downloaded them for entirely unrelated purposes. And Arity's code ran in the background, tracked location and driving behavior, and reported that data back to Allstate. That data was then used to inform insurance pricing and sold to third parties, including other insurance companies, to be used in their underwriting. Please let that land for a second. People who never opted into a telematics program, never signed up for Drivewise, never made a decision to share their driving data with an insurer, had their behavior tracked and monetized because they had happened to use a gas price app. So in March of 2026, a federal judge ruled the case could proceed, finding that drivers had enough of a claim to try to prove that Allstate violated the law through this phone tracking program. Now, a separate lawsuit raised a different but equally important dimension. A Florida driver named Philip Siefke bought a Toyota RAV4, enrolled in Progressive's Snapshot program, and later decided to opt out. When he looked into what had happened with his data, he found that Progressive already had driving information on him, not from Snapshot, but from data flowing through Toyota's connected vehicle systems. Toyota's cars have built-in connectivity that can share vehicle data with partners, and Progressive had a commercial relationship to receive that data. This shows a significant shift in how the telematics space is evolving. It started as a clear opt-in choice. Download an app or plug in a device and knowingly share your data for a discount. But we are moving rapidly toward a world where the data collection happens at the hardware level, through your vehicle's built-in systems, or through apps you use for other purposes entirely without any recognizable enrollment moment. Over 50% of non-telematics users in a survey said they would be more likely to opt in if insurers were more transparent about data use and promise not to sell their information to third parties. So that number suggests there is an appetite for these kinds of programs, but the problem is the behavior of the companies themselves has created legitimate reasons not to trust them. Now, legislators in Maryland, Missouri, New York, North Carolina, and Tennessee have introduced bills focused on telematics transparency and consumer protection. Maryland is considering legislation that would limit telematics programs to discounts only, meaning that participation could never result in a rate increase. Now, that kind of consumer protection, if it became standard, would change the calculation significantly. So go to your phone's location settings right now and check which apps have always-on location access. Any app with that permission could potentially be sharing your location data. You have the ability to revoke access, and for apps where you don't need real-time tracking, you should. Are you still making minimum payments and getting nowhere on your pile of debt? Let's change that. If your credit card balance feels like a boss fight that you just can't win, well, I made something for you. It's called the Easy Mode Guide to Destroy Your Debt, and it gives you the exact plan to break free. In this 23-page guide, we'll bust through common myths, learn step-by-step strategies, and you'll discover how to pay off your debt faster, without shame, overwhelm, or giving up everything that you enjoy. Whether you're into the snowball method, the avalanche method, or have no idea what either of those mean, this guide is for you. If you're ready to finally start paying down your debt, then this guide speaks plain English and delivers results. It's just $19.99 and it's available in my storefront. If you click the link down below to enter my stand store, you'll see a big green button to purchase the guide. Please don't let another month slip by with no progress. Hit pause on this video, scroll down to the show notes, and click the link to download this guide. Now back to the show. Before you let your insurance company, or any company, watch your behavior, run these 3 questions first. We've covered what telematics is, the real savings numbers, and the data privacy situations that are currently working their way through the courts. Now let's talk about making the decision for yourself, because the answer isn't the same for everyone. The permission to profit test is 3 questions. Work through them in order before you enroll in any program. Question 1, can my rate go up? This is the most important question. Telematics programs fall into 2 categories. Discount-only programs can only lower your rate or leave it unchanged. You participate, you either save money or you break even, and the insurer uses the data to better understand their risk pool, but cannot penalize you individually. The other category, which includes several of the largest programs in the industry, can raise your premium if the data shows behavior the algorithm classifies as risky. If you enroll in a program that can raise your rate, you are not only signing up for a potential discount, you are agreeing to a test that can fail you. Get this answer before you do anything else. Call the insurer, ask them directly. Can my premium increase as a result of telematics participation? Then follow up by asking what specific behaviors trigger rate increases. Question number 2. What exactly is collected and who gets it? Read the privacy policy for the specific telematics program, not just the general car insurance policy. Then look for 3 things: what data they collect, how long they retain it, and who they share it with. Specifically look for the words third party, data broker, and sell. If you find language about sharing behavioral data with third parties or selling aggregated or de-identified data to outside companies, you're not just sharing your information with your insurer. You're contributing to a commercial data product. Some programs are limited in scope. They collect driving behavior, use it to set your rate, and keep it internal. But others are operating at the scale we saw with Allstate and Arity. The privacy policy will disclose this information, so reading it is the only way to know which type you're dealing with. And finally, question 3, does the math actually work? Take your current annual premium, apply a realistic discount, not the marketing maximum, but something in the range of 7 to 12% for a consistently safe driver. Then run the numbers. Is that savings worth the data that you're sharing and the risk of an increased rate? For some people, particularly younger drivers with clean records, paying meaningful premiums, then the answer is yes. But for others, especially drivers with predictable schedules, older vehicles, or lower base premiums, the math may not move the needle enough to justify the trade-off. One final thing worth tracking, the industry is growing very fast. In 2024, more than 21 million Americans shared telematic data with their insurer, growing at roughly 28% per year since 2018. Now, as more people participate, there's a real question about whether opting out eventually starts to signal something else to insurers, but we're not there yet. But the trajectory of this industry suggests that telematics isn't going to become less common, it's going to become more embedded, more automatic, and harder to avoid. Now, I want to take a minute and zoom out because your insurance company is an early example of a much larger pattern. The products you pay for are increasingly monetizing your behavior on the side. We've been talking about insurance telematics specifically, but zooming out, I want to talk about the dynamics here that are starting to show up in a lot of places beyond insurance. Your newer vehicle is almost certainly collecting data about your driving, whether or not you've signed up for anything. Major manufacturers like Ford, GM, Toyota, and Honda have connected vehicle platforms that continuously transmit mileage, speed, location, braking patterns, and more. The data agreements may vary by manufacturer, and the disclosure to drivers about what's collected and who it goes to is inconsistent. So the FTC has started investigating automaker data sharing practices. Legislators in multiple states have introduced telematics-specific consumer protection bills. There's active litigation happening right now. The rules are being written in real time, which means what's true today may be different in 2 to 3 years. But the broader principle is worth naming. Over the last decade, a pattern has emerged in consumer products where the thing you paid for is no longer the only thing being sold. Your streaming service watches what you watch and sells that attention to advertisers. Your fitness tracker knows your sleep patterns, your resting heart rate, and your daily movement, and that data has commercial value. Your phone apps know which other apps you use, when you use them, and for how long. And now your car knows where you go, how fast you got there, and how smoothly you brake. In each case, you can get something for giving up that data: better recommendations, personalized content, and potential discounts. But the question worth asking each time is whether that exchange is transparent, whether the data is being used only in the ways you expect, and whether you have real and practical control over it. With auto insurer telematics right now, the honest answer to those 3 questions is mixed. The Allstate lawsuit suggests collection was not transparent for tens of millions of people. The Progressive and Toyota situation suggests that opting out of a program doesn't necessarily end the data collection. And consumer control is limited, partly because the disclosure is buried in privacy policies that few people read, and partly because some of the data collection happens at the vehicle level rather than through an app you can simply uninstall. None of this means the right answer is to never share your data. A discount-only program with clean privacy terms, no third-party data sales, and a meaningful savings number for your specific situation is a legitimate deal. But Let Us Watch You Drive deserves the same skepticism you'd apply to anything where the product being sold might actually be you. So here's your homework for this week, which you can knock out in about 30 minutes. Step 1, find your current auto insurance company's telematics program. Google your insurer's name plus usage-based insurance or telematics. Navigate to the enrollment page. Then step 2 is to find the privacy policy for that specific program. It's usually linked from the enrollment page, not the main policy page. Open that up and search for the word sell, third party, and data broker. Screenshot whatever you find. Then step 3 is to call your insurance customer service number and ask them directly, can my auto insurance rate increase if I enroll in your telematics program? Then write down what they told you. By the end of that 30 minutes, you'll have run the first 2 questions of the permission to profit test. You'll know whether your data is being sold and whether your rate can go the wrong direction. That's enough information to make a decision. If both answers come back clean, then the third question is simple math. Look at your current premium and see what a realistic 7 to 12% discount would save you. If that number is worth it, you got what you need and you can say yes. If the answers come back murky, well, then you've got your answer too. We started this episode with the pitch. Let us watch you drive and we'll give you a discount. And the pitch isn't entirely wrong. Some people do save meaningful money. The median savings is $120 a year, which is real. Younger drivers and high mileage drivers can save even more. But the full picture is more complicated. Several of the biggest programs can raise your rates, not just lower them. The Allstate and Arity situation revealed that data collection has been happening at a scale and through channels that most people never consented to. And the Toyota and Progressive situation showed that opting out of a program doesn't stop their surveillance. So the permission to profit test gives you 3 things to verify before you decide. Can your rate go up? What data is being collected and sold to who? And whether the math works for you. Those 3 questions will give you a cleaner picture than any marketing page. If you found this useful, I'd love if you subscribe to Your Money on Easy Mode on Spotify, Apple Podcasts, or YouTube. New full episodes drop every other Sunday. And if you've got a friend or family member who's been thinking about signing up for one of these driving programs, send them this episode. The privacy and rate implications are almost never part of the conversation when people are deciding, and they should be.
Thanks for listening to Your Money on Easy Mode. If you enjoyed this episode, then please subscribe and share it with a friend.